Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Another week, another screeching U-turn on trade. Investors' recent optimism turned out to be somewhat justified at the start of this week when the US and China announced a truce of sorts in their burgeoning trade war. But we're not quite back to where we were pre-quote-unquote Liberation Day, so all eyes are now on what the last 6 weeks of back and forth have done to the US economy. Today, we look at this through our regular lens of company reporting and start with credit checker Experian, which posted full-year figures on Wednesday. Julian Hofmann is here to talk us through those results and discuss how the company might fare in the event of a US economic slowdown. Then we talk about another large-cap stock, Imperial Brands, whose shares slumped this week on news of its CEO's surprise departure. Chris Akers will look at that reaction and cover the tobacco business's half-year figures. To finish, we will change pace entirely if you've ever considered junking it all in to go travelling around the world, whether in retirement or earlier. Val Cipriani is here to talk through what you need to do to prepare your finances and your investments for that moment. Experian first up, though. Julian, let's talk about the results themselves. As we've come to expect from the company, credit analysis and what have you is its bag. The results fairly solid. It's a fairly quality business. Can you talk us through what went right and what we learn from these figures in short?
Yeah, thanks, Dan. Yes, Experian, who are oddly sensitive about being called a credit checking company, but for some bizarre reason. But the results themselves were acceptable, I would say, is the operative word. You know, the sales were up about 6%. Profits were largely flat, but that was because of one-off costs related to redundancy program. I mean, they're also migrating quite a lot online, so there's onto a sort of cloud platform. So there were costs associated with that. But otherwise, as you come to expect for such a sort of capital light business, it doesn't need a huge amount to run in terms of its infrastructure. It is churning out a lot of cash and at a conversion rate of nearly 100%. So if I were the management, I would be quite happy with that. If you're an investor, it's a slightly nuanced story, I think. What was noticeable in the results was that they depend largely on three countries, which is Experian's usual thing is that they like to say, well, we have a very broad portfolio. Look at South America, look at Latin America. But when you actually dig into the proportion of the results that are related to individual economies, it's still the US, which is their major driver, along with Brazil and UK, Ireland. So that together makes about 91% of all sales. And it was the return of some growth in the US that was behind the solid nature of the results. So it kind of emphasizes that they are still a very mature economy-focused, based and dependent business, which of its own is not a bad thing. But the question now, as we look forward, and we'll see the results are looking back to the last quarter, is how that will affect their performance this year if America goes into a more than anticipated recession because of tariffs or because of general economic policy chaos in the US. The positive thing, obviously, is that credit checking is such an embedded part of our society and economies that it's almost like a public utility, really. So whether times are good or bad, you're going to get your credit checked one way or another, which is the positive way to look at the kind of defensiveness of that business. But so it was a broadly positive set of results, but it wasn't, I don't think, particularly exciting when you consider that the rating is now about 30 for this year coming. You're paying a lot, really, for a dividend of about 1.4% yield. So it's a solid growth story, but it's not an exciting one. And I do wonder whether investors now need to start talking about the company as a utility type business rather than sort of this breakneck growth that we've had over the last few years. and growth really it does come through acquisitions for the business. So they've made another $1 billion of acquisitions during the year, and that will again flow through into the next set of results. But yeah, so I would argue that we need to think of it more as something more boring than a kind of tech-based company, which is how we tend to think of them.
Yeah, they obviously like to emphasize that aspect, don't they? And there are some points in their favor there in terms of the technology they use and data analytics and things like that. But it is a company that its quality is that kind of slow, stable boringness, really, isn't it? Being a quality compounder, able to grow the top line and margins a little bit each year. What do we see in terms of divisions in these results? Because as you say, that core business is credit checking for companies and banks in particular, as well as for individuals in the US. The US is about 2/3 of the business, but there's other strings to its bow. Things such as identity verification. I believe it's looking at insurance quite a bit more in the US and Brazil, trying to become a bit more of a whole of market financial services business in that way. What kind of figures did we see in these results from some of those perhaps less heralded divisions or arms in terms of how it's growing?
Yeah, I mean, the identity recognition is a big area at the moment because it's related to internet security. Experian in these results, I think they were growing by 8%. Well, at least their identity checking business is growing faster than the top line. So there is a certain gearing there, which is quite positive for them. It's just not a huge part of the overall package. But as you say, they are looking at most of their acquisitions this year have been focused on that sort of tech recognition security area. So we could see, if you do a comparable set of results in a year's time, you could see that taking up a larger proportion of what they do. And it's also slightly more profitable, I think, because obviously doing just identity recognition is less intensive than perhaps doing an entire credit history check and then producing a report. So it could have they could have the possibility of generating bigger margins, although they don't actually break that out in the results themselves. But that is an area to watch as we go into the next couple of quarters. Particularly, I think if we see the business-to-business side in the US suffer a bit for structural reasons or whatever happens in the broader economy. But on an individual basis, people are still going to get either their recognition done or they're going to need their credit histories. And so, yeah, I mean, that's where the defensiveness comes from.
Yeah. They're also moving a lot of their B2B customers to a new platform, the Ascend platform, they call it, which I think is a way for them to effectively cross-sell more stuff to these customers. Looking at guidance for the year ahead, we'll come on to maybe the macro backdrop as part of this, but what did the company guide for their next year, which runs, well, effectively from the month we've just had, from the start of April to the end of March next year?
The company, according to the CEO, is expecting revenue growth of about 9 to 11% this year. That implies roughly a third up of where they are at the moment. And the margin should come in a range of margin expansion should be somewhere between 30 and 50 basis points. So as he said, it's not world beating, but it's very steady. And that's where the value of the company is at the moment.
Let's talk about the context, the economic environment, because typically, as we've alluded to, credit checking, credit scores, things like that are counter-cyclical in that people might want to check their credit rating more regularly when times are tougher. That said, there are a lot of parts to Experian's business nowadays, and when you look at the performance of countries like Brazil and even the UK in these results, where the economies aren't growing so much, the results have maybe not been as strong accordingly. Do we think it would be well placed if there is a US slowdown?
Well, that is a difficult question because the Brazilian economy, which is also a big part of, as we said, is a big part of their business, has been in a slowdown with a high interest rates causing problems. And what they've seen there is, I think, indicative of it's almost like I would say canary effect, where it's business to business services which have suffered. That was what kept that division's sales down during the last year. That might be unique to Brazil, but you might make a case to say if you took that business to business those business to business problems and translated them onto a much larger economy, like the US, for example, that could cause some serious problems, because obviously if you a business to business package on an individual basis is far more valuable for Experian, because one business is obviously worth perhaps tens of thousands of individual credit reports. So you'd have to do a lot of consumers checking credit to make up for the loss of one business client, or one business client cutting back on its on services that it uses from Experian. So there is a little bit of a downside to that. What we don't know is whether that will translate immediately into next year, or whether in the meantime they can buy businesses in other areas that will make up any shortfall. Which is, I think, an intention that they tend to do. If they see a problem in one area, they tend to buy something in another area, which brings in an immediate revenue gain. So yeah, I mean, they have time, in a sense. They have time on their side because they can prepare for those kind of eventualities. But if they're still saying that their growth is going to be in effect 20% higher than it was this year, then that implies they don't see that sort of business to business slowdown coming through in a place like the US.
Exactly. Yeah. I think, as we've said, sort of revenue growth around 10% next year. On the earnings call, I think they were asked about this, and the CEO said, well, we're not expecting much of an improvement, but not really expecting things to get much worse either. So we'll see if that holds. And they also pointed to, I think they were asked about things like consumer confidence dropping off a cliff in the US, but they said really it's things like the unemployment data that really matter for them. So if that starts to turn over, that might be when it's more of an issue, but we'll see. Just to wrap up, we've talked about the valuation a little bit already. It is a rich valuation, but I mean, there is an element of paying up for a quality business there, which speaks to its favor, perhaps.
Yeah, I think that's correct. I mean, and the shares have pretty much held up over the last 12 months. It's not like it's an overhyped or overvalued business at all, really. And you are just paying the premium for what would be like a utility style regularity, I think. But it's definitely it doesn't use up anywhere near as much capex spending as other businesses, and there's always demand for its services in one way or another. So yes, it's an ideal. If you wanted to use it as the one quality buy in a portfolio, maybe that's the way that investors would see it.
Indeed. Well, we've got to move on now. We're going to look at Imperial Brands. Chris, you covered the figures for us, but before we get on to those, let's talk about the chief executive leaving, because that really knocked the shares this week. Quite surprising, maybe to me at least, the extent of that fall for the departure of an executive at a business which, while, as we'll get onto it, it's trying to move into non-combustible alternatives, shall we say, i.e. non-cigarettes, things like that. But nonetheless, these businesses are, in a way, in kind of managed decline. To me, it's a little surprising that a CEO departure of that kind of business would cause a share price drop of 6-7% or so. But I mean, at the same time, perhaps it does show the respect with which the market viewed him. What's your take on the departure, and what are they doing in terms of replacement?
Yeah, so Imperial Brands shares fell 7% on the day when they announced the surprise retirement of Chief Executive Stefan Bomhard. I think obviously part of the reaction is to do with it being a surprise. Investors weren't expecting this. Bomhard's been in the role for 5 years and is stepping down in October. But yeah, the decline really sort of highlights, as you say, Dan, that investors held him in high regard and have been pleased with his strategy. That can be seen in the more than 60% increase in the share price over 5 years, which compares to a flat performance at key London-listed competitor British American Tobacco. So as far as I view it, investors like his strategy, focusing more on the company's 5 key tobacco markets, how he handled tobacco pricing in the context of long-term declining volumes, given cigarettes are what drives returns at a company like Imperial. At the same time, there's also been reduced losses in the alternative products business. And the wider strategy supported some quite attractive buyback programs. I think around 15% of the shares have been repurchased since October 22, according to Annual Liberum. And just on continuity, it is worth noting that investors should expect sort of continuity in strategy. The current chief financial officer is stepping up to become chief executive. The strategy officer is becoming the new CFO, and the chair is remaining in place. So we shouldn't expect any major changes going forwards.
Mm. Perhaps my use of managed decline was a bit unfair. I mean, as you say, shares have been rising a lot in recent years, but I was thinking, I suppose, in the context of a business where the new products are still a very small part of the overall mix.
Yeah.
Cigarette smoking numbers are growing due to population growth, and clearly the strategy at Imperial is working well in that regard. But nonetheless, you can see the parameters of the business quite reasonably far out, one would think, in terms of the big threats being, as always with cigarettes, increased regulation, increased legislation, offsetting any attempt to move into other areas. But let's look at the figures themselves for the period just gone. What did we learn from this latest set of results? What is doing particularly well for Imperial at the moment?
Yeah, in terms of the actual figures in the half-year results, no surprises. The figures were in line. So you had reported operating profit down about 3%, and the company maintained annual guidance. At a high level, it's really the story we're used to by now with the tobacco companies, with higher prices offsetting lower volumes. So price mix was up about 6%, and volumes were down 3% in the half. Imperial made tobacco market share gains in 3 of its 5 key markets. So it made gains in the US, Germany, and Australia, but its share declined in the UK and Spain. And on alternative products, which we'll come to, I think, in a bit more detail, the company saw growth in Europe and the US, but weakness elsewhere.
Mm. Let's talk about the strategy. You said this distinguishes it from BAT, but how does it compare with also the likes of Philip Morris? And it had a Capital Markets Day, Imperial, in March, I believe. What did it say there in terms of what it wants to do in future as well?
Yeah, so one interesting difference with these peers is the pace of change with diversification into these sort of smokeless alternative products. So market leader Philip Morris, which is listed in New York, really stands out on this. It expects more than 2/3 of its net revenue to come from these products by 2030. In London, British American Tobacco is targeting 50% of revenue from these products by 2035. On the other hand, Imperial hasn't set out a specific target quite like that. But as it said at the Capital Markets Day, it's aiming for double-digit net revenue growth on a compound basis over the next 5 years. And these products currently deliver only around 4% of net revenue at Imperial. I'd say Imperial stands out in a positive sense for its buyback agenda, with both BATS and Philip Morris having paused these in recent years to focus more on deleveraging and the balance sheet. I think something for investors to note is, just when we're looking at peers, Philip Morris's sort of much quicker diversification is partly why it has a much more expensive valuation. It's on about 22 times forward earnings compared to 9 times for the London listed stocks.
Yeah, that progress, if you want to call it that, with next generation products is a particular reason why, as you say, Philip Morris is more highly rated. The nicotine pouches, particularly popular with Gen Z, I believe. That's one of my only facts about Gen Z, which I cling to like a man in the middle of a stream holding onto a rock as the waves sweep me away. But we digress. Let's talk about those products and what Imperial Brands is doing, because it has its own zone pouch, I understand, which is part of that next generation product group, which they're trying to roll out in the US and grow that segment a bit more. There's obviously big competition from the likes of Philip Morris, also from products which are cheaper and perhaps even slightly more illicit, shall we say, as I think the phrase some analysts use, i.e. some sales could be taken off by those kind of competitors as well? What do we see in terms of the next generation product growth opportunities as the company would see them?
Yeah, absolutely. So the company calls its non-combustible products like vapes, heated tobacco, oral nicotine pouches, they call them next generation products. So net revenue for these products was up 15% in the half year results, and the division's losses were cut by 14%, down to 43 million. So that's good progress. But we need to remember, as I mentioned, that this is still a very small part of the overall operation, at just 4% of net revenue. And again, it doesn't have a specific medium-term target quite like its peers. Interestingly, when I spoke to the company for a recent feature, it did note that the sort of wider industry doesn't have a good track record of setting targets for these sorts of products and hitting them. So I think that's something to bear in mind. Yeah, there's quite a big risk with illicit. Yeah, that's the word used in the industry. Illicit vapes, sort of flooding the US market from China. Enforcement is proving quite a challenge, and that's causing some significant issues for the big players in the market, the big legal players, and how they sort of focus investment in the US. So yeah, that's a key risk to bear in mind.
Just to wrap up, the valuation case still fairly strongly pinned on the dividend buyback outlook. Is that fair to say?
Yeah, absolutely. I think given the context of, secular decline in tobacco volumes, a small part of the business at the moment that is alternative products, and ethical concerns with cigarettes that some investors might want to consider when buying a stock like Imperial. I think given that, the return to capital is key. And again, the sort of buyback program at Imperial is quite attractive relatively. I could have mentioned at its Capital Markets Day, it confirms what it calls an evergreen buyback, which means a buyback every year out to 2030. It's also promised dividend growth each year. So yeah, I think given that context, dividend and buyback it's key in the main attraction. Something to note for anyone looking at the recent half year results is the sort of big jump in the dividends is down to a change in dividend policy. So that the payment profile has changed to 4 quarterly payments for this year onwards, and because of the rebasing, you have 2 interim dividend payments. So just something to note there.
Indeed. Well, it is clearly a very polarizing industry, but there's a lot going on at Imperial, and I think you've given a good account there, Chris. We will keep monitoring that in the months ahead. To finish today, though, as I said at the top, we're going to change pace. We're going to look at one of the features in our personal finance section this week, which is all about investing in order to be able to travel the world. Not so much about how to amass enough money to do so, but more about what kind of things you need to get in order and how you need to arrange your portfolio and your funds in order to do this, to travel around. Val, you wrote the piece. Why don't we start by talking about the basics, really? Cash buffer is the first thing. So rather than the investments, let's talk about what kind of emergency buffer you might want if you're about to leave your job or leave your home, that kind of thing, and travel around for a while, as some of our readers often ask us about and often do.
Yeah, definitely. So I think you start by thinking, you're thinking of how much money you're going to need. And then you start by thinking, okay, what if something goes wrong, right? Because if you're on a big trip around the world that lasts potentially months or even years, we've had some readers ask about that, then you have to consider sort of some worst case scenarios potentially. So the cash, the sort of having a good reserve of cash is really important. It's something you would need to do anyway if you are, for example, retiring. So you would need to have some cash aside because you don't want to cash in from your investments if you need money at the wrong time. So you kind of start from the same really starting point, but then I think you increase the buffer a bit to account for the fact that you are, potentially in a foreign country, potentially might have some quite expensive emergency, you need to come back home for some reason. So I think one of the experts I spoke to talked about 1 year's worth of expenses as a starting point, which again will, you can change according to what your plans are. It could be even a bit more if you're, on a big trip throughout the whole year.
Indeed. And for those who do own properties as well, that's something to consider, i.e. what you do with that if you're leaving. There's a number of perhaps quite logical options here, but why don't we just sort of run through the pros and cons maybe of individual choices here?
So I think, maybe the most straightforward option is actually just to do nothing with it, which is a bit counterintuitive. But the other options do have some complications you need to keep in mind. So, you especially if you're not away, if you're away for just a year, it might well be that the easiest thing to do is just leave the home empty, make sure you've got a family member or a friend keeping an eye on it, checking it out every now and then, that's kind of it. And then obviously the other two options are either selling or renting it out, which work better if you are planning a longer absence from the country. But as I said, both of those have some downsides that you really do need to keep in mind. So if you sell, when eventually you will presumably come back to the UK, maybe if you plan not to do that, then the conversation is different. But if you plan to come back, you will eventually need a place to live. So if you need to then buy again a property of a similar size, you will have house prices having increased, and also you will have to pay stamp duty on the transaction. So it really could not make that much sense, even though instinctively having that big pot of money that you get from the sale of a house and investing it and using the proceeds to travel is very useful and very flexible. But maybe it mostly makes sense if you were gonna say, downsize in retirement anyway, so you needed to do that transaction anyway, then maybe it makes more sense. And then obviously renting out the property is a good way of generating some income, but you do need to consider that you will most likely need someone to manage the property, and you may have to pay them because obviously you will not be in the country if your tenants have a problem, if the boiler breaks or whatever. And then obviously there is income tax to pay on whatever you earn on that property as well.
When we talk about the planning in terms of working out how much money one might need, we can kind of fall back on some of the tools we've spoken about before on this show and discussed in our pages. But there are, in short, free financial planning tools you can use to try and set some parameters and work out what you might need for months or even longer away from home.
Yeah, they are quite handy. I think obviously, you can just do the basic thing of trying to work out what percentage or what figure of your portfolio you can draw every year, again, as you do for any kind of retirement planning, and sort of take it from there. But those tools are just a little more sophisticated in terms of, calculating the long-term assumptions for you, potentially helping set different levels of expenses for different periods of your life, because obviously when you are traveling you will need more money than you might then need when you're a bit older and come back to the UK and have a different lifestyle. So they just allow you to do those flexible things, and I think the important point here is that obviously if you go travel at the beginning of your retirement, but that is your retirement and that is your retirement pot. Traveling is only the first bit, but then you have to kind of consider how much and what you will need for decades, potentially, depending on your age and how long you live for. So doing that kind of maths on your own is quite hard, but there are some free tools that can help.
Yeah, we do reference those in the article, so take a look at that for a bit more detail. What about the portfolio itself then? What kind of portfolio should you consider building? Clearly, it needs to be something that is relatively hands-off because, as you say in the piece, you don't want to be spending your time seeing the world, constantly checking or adjusting or drawing from your portfolio manually.
Yeah, you want to automate the process, don't you? Because it's not what you're out in the world for. So there is very much a case for focusing and automating the income side of things, because obviously you could have you could have a growth focused portfolio. There's nothing stopping you from it. But then if you have to kind of even vaguely time the withdrawals, so sell funds or sell stocks at certain moments to then fund your travels, then it does require you keeping an eye on things, and so it's not really compatible for that kind of traveling lifestyle. So you focus on building an income portfolio. It doesn't necessarily mean that it should be a no growth, just bonds and very boring income stocks portfolio. It more means that you want to have a degree of certainty that your investments are going to pay a certain level of income, and that is going to be enough to sort of fund yourself.
Yeah, I think that's definitely sensible. As you say, you need that reliability and the ability to, as you also mentioned, to automate things, make sure you don't really have to do anything at all, ideally, once you're away. That does translate into some issues with investment trusts, which we get into in the piece, but maybe we won't actually go into now, just in terms of how they generate that income. Something to watch for or keep in mind before you plan to depart, in short. But maybe we can just finish up by talking about tax and the tax status you might find yourself gaining or losing as you move around the world. Is something to be aware of, and maybe people don't consider.
Yeah, it's something worth looking into. It's quite complicated. The general idea is that in most cases, if you're not moving away permanently, you will likely still be a UK tax resident. So you will have to pay your UK taxes, especially, on any kind of, say, income. So, for example, pension income you might get in the country. So you have your UK taxes that still need doing. However, you will also need to keep an eye on how much time you spend in each foreign country, especially if you stop somewhere for quite a long time, because there are different rules in terms of, how long you can be in a country without becoming a tax resident there as well. So you might find yourself basically owing taxes in two places. And then the UK has what they're called double tax agreements with a lot of countries that ensure, again, that you're able to only pay tax in one country. But you do need to do your due diligence because the rules are very different for each country. So it can get a bit complicated. So just something to keep in mind and look into.
Mm. Well, the full feature has a bigger checklist of things to keep in mind and things to pay attention to, so do check that out online and in print. For today, though, we've come to the end of the show, so thank you very much to Val, to Chris, to Julian, and our producer, Maddie Apthorpe. We will be back next week with another Companies and Markets show.